Good afternoon, or good morning, I guess. Good morning, Digital Wildcatters. We're recording this Monday, May 15th, but you're actually watching this the morning of Tuesday, May 16th. We have a special guest. Now, Mark, help me introduce the special guest, but we've got to frame this. We have traded Colin and I guess Kirk. So it's 2 for 1.
Kirk.
What trade in baseball history is this? Is this Bagwell for Anderson?
It could be close to that. Although I have to give props to Kirk. His absence is due to his participation in the qualifier for the Senior U.S. Open.
Wow.
Down in Pearland, I believe. Yes, I have looked for live scoring. It's not available, especially after the weekend he had with his travel odyssey and other things. But he tweeted out this morning his prep was stopping for gas station tacos before he hit the course.
Nice. So BDE fans, we have traded Colin and Kirk this week for Sean Maher.
Chuck,
thanks for
Mark,
joining us today.
pleasure.
Good
Always.
to have you. Okay, real quick before we jump in,
Yes.
quick Mother's Day story. I will go first.
Okay.
I was reminded by my dear sweet mother, who I had dinner with last night, that when I was brought home from the hospital as a little baby, Dad was finishing med school. My crib was in the room that included all of Dad's med school books.
Okay.
And supposedly I was able to stand up and rock the crib so that I could make it move. And every morning, my mom said literally every morning, she would come in. I had rocked the cradle over to Dad's med school books. I had grabbed one certain book and I was reading it each morning when Mom came in. Do you know what that book was?
What?
Literally everything about syphilis. Now, my parents have concluded that it was a red leather book, that, it was red and that's what drew it to me. But
Right. Yeah.
And
now they know
that confirms that Chuck has the highest awkwardness threshold I have ever seen.
All right, quick Mother's Day story.
All right. So quick Mother's Day story. This was the first year I've got 2 kids, 14 and 11. And this was the first year I went to both of them about 3 weeks ago. I said, Mother's Day is coming up. What are we going to do? And they both had gifts and cards ready for like what they were going to get my wife. And I was like, this is really cool if I've graduated to the point where my kids are accountable, because I got my wife something on Amazon the day before because I forgot.
Nice. Strong. You had Parent of the Year there until the last sentence.
No,
we'll edit that
Parent
out.
of the Year versus Husband of the Year.
That's
right?
true.
No,
you won
no.
Parent of the Year. You
Yeah.
may have finished down ballot on.
Yeah.
I would say Kids of the Year for being so
Kids of the Year.
prepared so
doubt.
early. Mine is from yesterday after doing the same thing on Amazon and reminding my son, who is now past his senior year in high school. So it's that fun downtime that's mostly spent sleeping and having fun with your friends between now and graduation. I reminded him that, he needed to be present and we needed to get cards and all of that. So we went out Saturday, did all that. And of course, Saturday night is usually the night he goes and hangs out with some other friends, and they all spend the night at a friend's house. And so he texts me late Saturday evening saying, hey, I think I'm going to be home tomorrow. We're spending the night and I'll get home pretty early. So around 10:45, I'm sitting in the family room drinking coffee and he's nowhere to be found. Haven't heard from him. I texted a 2-word text, define early.
Ooh, nice.
No
it
passive
all went
aggressive.
It all went fine. But that's, I'm going to relay the story of an 11 and a 14-year-old being prepared. How many weeks? 2 weeks ahead?
I am keeping all of the children communications quiet. I will not fess up or embarrass any children that should be embarrassed on the BDE show. But all right, Sean, you're here, and it's awesome that you're here.
Thanks.
Because big, huge freaking deal happened in pipeline world.
Yeah.
As I was listening to this morning on CNBC driving in, ONEOK, that's how they pronounced it, ONEOK bought Magellan. Tell us about this deal.
Look, I think so. There's been a lot of talk about the energy sector, whether you're talking about E&P, midstream, in terms of necessary consolidation. And historically, when you think about the midstream space, these are long-lived assets. They are generally very stable, and you've got that with both ONEOK and Magellan. These are two very stable businesses with very deliberate management teams. Um, it was not a transaction that one could say was hand in glove. Like there weren't a lot of direct operational synergies, and you saw that with some of the prior deals that have been done. You had Enterprise bought Navitas, which was a great transaction. Energy Transfer and Enable, that was a public to public. Then you had Targa and Lucid, and most recently Energy Transfer and Lotus. Those all had some strong operational complements to one another in terms of synergies and building out the core footprint. Magellan and ONEOK was unique in that it was two very different businesses, two very stable businesses, but it took ONEOK, which had, call it, three core competencies, and Magellan, which had two core competencies, refined product and crude oil transportation and storage, merged them together. So it, from a ONEOK's perspective, it made the company more defensible. It took them out of just the gathering and processing narrative, if you will. A great company, very disciplined, but they had Bakken exposure, which they have Bakken exposure because they're primarily a Bakken company, and that I think was probably cause for some investor angst, justifiably or not. But when you merge the company with Magellan, you've got a very, very stable footprint through the central part of the U.S. And so when you look at when you actually look at the map of the pipeline infrastructure that's in place post the transaction, it's very complementary right up and down, the central states. And so now and they're both Tulsa-based companies. So a lot of times when you deal with M&A, there's obviously the cultural fit and what are you looking for in terms of making sure that your employees are taken care of, making sure your communities are taken care of. So this does a lot in terms of solidifying the business structure, the business environment in Tulsa by keeping a lot of people employed, because there isn't a lot of G&A overhead except at the very top level.
Stuff I didn't understand that I read about, because I've never been much of an MLP guy. We did a lot of that at Kane, but wasn't my group. There was a whole tax issue about how this is going to be taxable to Magellan holders. So what does that mean?
Sure. So the beauty of the MLP structure, the partnership structure, is you receive current distributions, and those are tax deferred. So the distribution you receive on an annual basis goes to reduce the basis of your investment. You buy a stock at 20, you get $1 dividend. Now your basis goes down to 19. So that's great, because as long as you own that partnership unit, you don't have a tax basis, or you don't have to pay taxes on those current income streams. It's only at the time of sale. And so one of the things that became challenging for long-term that becomes challenging for long-term midstream investors is their ability to monetize positions if they've got a very low basis in the security. Now with ONEOK buying the company, you have a C Corp buying a partnership. So this is not something where you can do a like-kind exchange and have one partnership go to another partnership, exchange units, and then continue that tax deferral down to your basis. This is a sale. This is an outright sale. And so as a result of that, you'll get $25 in cash and 0.667 ONEOK units. But that is going to be a taxable transaction. So Magellan, which always had a premium multiple from an MLP perspective, hasn't issued equity since 2010. So one of the things that Magellan was really good about was obviously managing their capital budgets, managing their business. But by not issuing equity, it meant that all of your unit holders essentially became trapped. It's the prisoner's dilemma. I've got this really great company. It's paying me a great yield, but if I sell it, I'm going to have a big tax hit. Well, now as a result of the C corp buying the partnership, you're going to end up with a tax hit for the LP, and that what that means is it rewrites the basis higher for the acquirer, which allows ONEOK to defer taxable income for, I think it was 3 years, is what they've laid out in this case. And this gets to, there's a history here in terms of other C corps buying MLPs and pushing tax burdens down to the limited partnership, to the limited partners. And I don't have any reason to, um, I don't have any reason that this is accurate or inaccurate, but I would imagine that a big reason for the $25 cash component was to help MMP shareholders be able to pay that current income tax liability. And then you end up with a secure piece of paper defined as ONEOK, which is a C corp and a nicely consolidated business.
And ONEOK is issuing notes to pay that cash component.
Correct.
You know,
A significant portion of it.
that's interesting you brought that up, because when RSP bought Silver Hill, it was the same thing. RSP was C corp, Silver Hill was a private partnership, and we had investors in our fund because we took $1.2 billion of cash, $1.2 billion of stock. We had investors begging us not to sell the shares and just distribute them, because they were like, we just want to keep the tax base. And I had to tell them, no,
Yeah.
You cannot buy, in effect, an asset, right? Because it's a flow through entity. Yeah, that's a taxable event. So if I go sell your shares for you and send you cash, you can go buy RSP stock and you may have lost 3 cents a share or whatever it cost me to trade out. So
I mean, there's great companies that you want to own for a really long time. There's no doubt about it. The concern becomes when you're not transacting because of concern around a potential tax liability, right? And um, this has been floated in the past, urban legend or market history. There are people who have thought about doing acquisitions, and the transactions have been shelled or shut down simply because there was concern around how would the equity trade post the transaction because of this big basis differential, big
Yeah.
basis issue.
Going back to a point you were talking about, and real or perceived, about inventory life as it relates to ONEOK and the whole Bakken headline or the Bakken exposure. We were talking about before the show something about, which I think is just fundamental as we get into later life for any of these unconventional plays, is rising GOR and what that potentially means for ONEOK legacy asset base relative to its advantaged NGL positioning and how robust that whole segment of the business has been. And I think we're going to see that elsewhere as we get further and further into this this runway issue story, right?
I think that's right. I think ONEOK, to their credit, has always been, again, very disciplined and very thoughtful in terms of how they've laid out their capital programs. They're notorious for under promising and over delivering. But one of the things that the market just does not appreciate, and I think that the ONEOK management teams have tried to do this, is when you start looking at the development of the Bakken, the higher GOR ratios, if you're a gathering and processing midstream company focused on the natural gas or the NGL component of that volumetric ramp up, then you want the higher GOR. It just makes your legacy business that much more valuable, which is how they continue to meet economic thresholds or economic goals and operational goals. So it's they've got a great footprint. So I do think that the Bakken risk conversation is a bit overdone, but
So, we had Kraken there, which was one of the largest operators, I think pre-COVID, 60,000 barrels a day or so. And at one point, I want to say we had 4 or 5 rigs running, really great operator there. My take on the Bakken was always at $55 oil, we kind of broke even, and it was sort of, do we do it or not? At $56 oil, we drilled 500% rate of return wells. And I've got to think with the oil field inflation that we've seen, that number's creeping up. So I do think there is a real worry outside of the GOR issue of just rigs laying down. I mean, it's got to be close.
Sure, but I mean, you're starting to see pushback on the producer side as well. Producers are starting to say rig rates are getting too high, service costs are getting too high. What that ultimately means, though, Chuck, is that prices have to go up. Right.
Yeah.
So, I mean, and at some point, the economic threshold will be met to drill that well. The beauty of what you have today, and this gets into the whole consolidation narrative, is you've got a lot fewer people making those decisions. So you're not competing against 20 operational peers, 2 of whom are the same market cap of you, and the other, 18 are ankle biters, for lack of a better term, right? They're just running around trying to pull a deal.
First ankle biter reference on BDE. I like it.
But consolidation does a really good thing because it limits your competitive universe. And if people are operating with a very disciplined mindset, which I think that's absolutely what we're seeing, then it's going to lend itself to transactions kind of like this. I think when I think about the ONEOK Magellan deal, and Mark and I were talking about this before, you can make the case for some M&A is 1 + 1 = 3, right? You have 2 very strong footprints, and then you take a lot of synergies, and you end up with more. I don't know that this is 1 + 1 = 3. It's probably more 1 + 1 = a very solid 2. And the reason why I think that's important is when you go back to consolidation, dating back to era of the super major, which is when I, started in the banking research world back in the late 90s, you had the best acquire or merge with the best, right? You had the good companies found good companies, and they found complements. They found people where you could have cultural fits. You had operational fits, but it lends itself to bigger scale, which improves margin. This is a cost-sensitive business. Your point about $55 a barrel versus 56, right? You want to get as much scale or as much production per employee or margin per employee as you can, and you do that through consolidation. Ultimately, what this develops into, though, is smaller players look around and start realizing that they're not being gobbled up, right? Because ONEOK and Magellan just merged. And so somebody who thought that they would be bought by ONEOK or merged with Magellan, now they're looking around saying, where do I go now? They try to artificially create scale by just taking one company, merging with another. So good M&A turns into okay M&A, turns into we're getting bigger for the sake of getting bigger, which doesn't improve returns on capital.
Or the music's about to stop and I need a chair, right?
Yeah, exactly.
And it just to kind of close the loop on that late 90s era of the super majors consolidation, what he was referring to, the best of the best, was the Exxon and Mobil merger that kicked it off, really. And if you contrast that with where ARCO ended up, which was right after the 1999 Sanford Bernstein Strategic Decisions Conference, if you remember, that was right around the time that The Economist published The Drowning in Oil, and it's going to be 10 forever, right? And another little sidebar, Matt Simmons called The Economist and told them not to run with the story, and they went ahead and did it anyway. Mike Bullen made the pronouncement at the Strategic Decisions Conference. At that time, we were entering the last days of the age of oil, and then shortly thereafter, they threw in the towel and sold at the bottom to BP.
Yeah. So, exit question on this story, real quick. How's the market treating the stocks of these 2 folks? Does that tell us anything? Do we have any predictions there?
So Magellan was up about 14% coming into this conversation. Magellan is generally a heavily shorted name in the midstream landscape because people thought it was fully valued. It was hard to garner incremental capital. I mean, Magellan has done a very good job. The returns on capital are great, but it was up significantly. Not a surprise when you're getting a 22% premium on a deal in the energy patch. ONEOK was down about 9%.
It's down a little over 8% right now.
And I think that's people just digesting what is a fair price. I think that Magellan traded at a premium. It was a good company, but again, there weren't a lot of sellers because they had a lot of legacy equity holders. And I think ONEOK is, and then the other thing, actually, I think ONEOK gets out of this, which I frankly hadn't thought of, was it does bring them closer to the water, right? So Magellan has ship channel access and exposure. So if you're trying to monetize that Bakken NGL and you can get closer and closer to the export docks, that's actually a huge win, and that could actually move the needle a little bit in terms of the value add. But
and pretty significant storage in Corpus Christi as well.
Correct. Yeah, absolutely. So look, the market's beating up ONEOK today. I think that time will tell, but it was a good deal. It's just one that it wasn't as aha. Right? Enterprise announced the acquisition of Navitas. That was probably the first big M&A deal. That was $3.25 billion, and Enterprise was up that day. It turned out to be a 3/4 payout, right? So Enterprise did pretty well with that transaction. Same thing with Energy Transfer and Lotus and Targa and Lucid. Like you could make that sense. This is just going to take longer for the market to digest, but they're two very, very good management teams, and Pierce, the CEO of ONEOK, is a very thoughtful guy, and he just took over the company 18 months ago again. So he's not doing this thinking that he's moving on anytime soon. He sees some real opportunities here.
Gotcha. An important difference in Navitas and Magellan, I guess, is, or at least the kind of legacy ONEOK issues related to the Bakken, is that Navitas was a Permian pure play.
Right.
Right.
Sure.
We're in a different time and place. I looked at index performance before coming in year to date and was surprised to see that the Alerian, maybe as a result of this pop, is leading the way. It's the only one that's up out of the OIH. The XOP is actually year to date leading the XLE, which is the majors heavy index, by about 100 basis points. I think 5.5 down 5.5 versus down 6.5. So actually that was a little surprising to me. I think these air pockets that we're seeing, and the intersection of what shareholders want, which is capital discipline and restraint, is something you alluded to earlier, is, continues to be significantly bullish for the macro structurally.
Yeah.
And with shareholders reacting, or the market reacting to, I think part of this is, it's hard to get away with a positive reaction. If you're paying a premium, I don't care about kind of the minutia of the deal, right? This is just the market backdrop we're in. So that's kind of a tough thing.
You're paying a 22% premium. People are going to take exception to that. And look, it's definitely the precursor to more M&A, because people are going to be looking around trying to figure out what to do. But take a step back a second. Consolidation is already going on. Companies are buying back their own stock all day long, right? So I think that's something that people need to appreciate, is if the market isn't going to value these companies for what they bring to the table, then they're going to look around and say, fine, we'll own it, we'll acquire it, and we'll take the duration risk, because we're sitting here, we see what we own, and we see the long-term value of this. You don't want it, that's fine. Go trade your 5 tech stocks. I'm going to take a 9% yield or a 10% yield, and I'm going to hold it for the next 25 years.
Yeah, and you and I talked about it the other day on our podcast. Nobody's valuing a tail. So.
No.
All right, Mark. Barclays puts out a report on the East African oil pipeline. You guys had talked about that, I think, 2 or 3 weeks ago when I was out. What'd the report say, and what was interesting about that?
Yeah, and this is a real quick update. We don't need to get into a lot of the details, but this is really one of those lightning rod type of projects. It's been a long-running saga. Total's involved. The Chinese are involved. It's a Uganda to Tanzania pipeline that has gotten all manner of pushback from various environmental and financing groups or stakeholders. The latest one, and the reason we talked about it a couple of weeks ago, was a headline over the prior weekend that Standard Chartered had declined to participate in financing the 1,400-mile pipeline. And that was largely due to their statement that it was inconsistent with essentially their kind of ESG principles, if you will, and I'll leave it at that. But interestingly, back in March, Lydia Rainforth, who is the lead European integrated oils analyst, had published a report that was the summary or the findings from an independent fact-finding mission to Uganda and Tanzania after doing a lot of prelude work, if you will, reading a lot about the human rights and the environmental impact assessments and aspects of the East African crude oil pipeline, and then going down in a very targeted, independently organized, not through Total, talking to various stakeholder groups, and then publishing a report around that. And the net of it was that, they were positive, acknowledging the concerns, publishing a lot of good data in the research report, like the affected persons who will be relocated in certain areas. Of course, the numbers that talk about displacement in the popular press way overstate the numbers of people that are affected, and certainly to the individuals, it's a big deal. But there has been, for example, in the compensation, the relocation programs, there's already been like an 85% acceptance in both when you combine the people who are going to be affected in Uganda and the people who are going to be affected in Tanzania. And that's mainly along the pipeline route, right? So if your agriculture and your homestead is upset, you may have to be relocated. Anyway, the point is that it was a very thoughtful and independently oriented assessment to get to the bottom of some of these issues, and being very balanced about, the validity of the concerns. But last month, Barclays CEO received a letter that was signed by over 40 activists demanding that the bank rescind the research note because it was opinions were unhelpfully biased. The oils analysts are unqualified to have an opinion on these issues, and that it was potentially damaging to the reputation of Barclays. So I don't know that the note's been rescinded. I've got it. I've read it, and I think it's, I'm biased to deep digging equity research analyst. Dan Pickering's motto with the shovel that he would hand out is always dig deeper. I think this is a great example of an equity research analyst digging deep on an important issue as it relates not only to the companies that she covers, but also generally what's going on in this constant point of friction between the opponents of oil and gas and doing what's right by certain countries economically that have, every right to develop their sovereign resources and assets and for their own well-being.
And again, the point is we can't have a thoughtful discussion on energy. We can't present opposing views. We can't debate those opposing views. You have to take away, I'm sure in that letter it said misinformation or some variation or some
greenwashing was in it.
Greenwashing, there we go.
I just think it's going to be really interesting to see that if a big global bank capitulates and does retract that research note, that's going to be, I don't think they will, but I've been wrong before.
Look, I would be surprised if they would do that, because at some point, Barclays has to understand that their job, this research analyst job, is to opine to a fiduciary who's allocating capital, right? And I think that the good news from what I've seen is at least some of the U.S. banks, and whether it's investment bank or otherwise, but J.P. Morgan, Jamie Dimon's been crystal clear on how he feels about the importance and necessity of energy, right? Crystal clear. Morgan Stanley's investing in their energy business. Jefferies is investing in their energy business. Like, at the end of the day, somebody will come pick up the slack. The problem is that the more banks that come out of the system, the harder it's going to be for smaller companies to grow and to access capital, because the larger banks are going to have different thresholds from leverage perspectives. And frankly, the larger companies are going to have less of a need because most of them are free cash flow positive. So all this does in taking banks out of the equation, whether it's Barclays or it's XYZ regional bank, it makes it more difficult for smaller companies to grow and potentially compete and add resource.
And it raises the cost of capital for everyone.
It raises the cost
for everyone.
Which raises the cost of energy for everybody out there. I hope that the CEO of Barclays is listening to me right now, and instead of capitulating, I hope he writes a sternly worded letter to those protesters.
And if you can get your hands on the research report, highly recommend it. It's a really good read and a great example of very thoughtful and deep research.
I guess, I would come back to something. Why is fear the right motivator? Why is sending a letter to the CEO of Barclays telling them that their research analysts should be fired and they're not qualified? Why is that the right answer? Why?
Because it works.
Well,
I mean, right?
It's
not right. It's effective.
It shouldn't. But I guess my point is, it shouldn't work. Like there should, if they took exception to the analyst's work, then they should publish their own rebuttal, which is fact.
So
it just gets sorry.
Yeah.
It just gets to this point of, you've got to look at a problem. You've got to look at this holistically. Mark brought up a number of points of these countries trying to do something to improve the lives of their own people, and to benefit from that, from their own volition. Like, it's their choice. So if the groups are coming in and speaking for them, then that's presumptuous and frankly unnerving. That's not how we're going to grow and evolve, and how we're going to end up with enough energy for another 3.5 billion people.
Well, and it's actually really simple. When you look at the psychological studies on how to change someone's mind, the three most effective ways are: number one, ask questions. That's why the Socratic teaching method is so effective. Number two is make them laugh, not you laugh, them laugh. And third, and arguably the most effective, is to scare them. I mean, you're connecting on an emotional level, so you scare them with threats and the like. The least effective way, according to the psychological studies, facts and reason.
We'll just hit this other one we were talking about earlier as an example of maybe some of this unity on the activism side, and the opposition is starting to show a little bit of dissension. And there was a story I just picked up before we came in about the two largest shareholder advisory groups, ISS and Glass Lewis, are now advising opposite one another on the latest stories about Total's upcoming shareholder meeting, a resolution that a Dutch activist organization called Follow This has put to a shareholder vote for the upcoming annual meeting for Total. And it's essentially what we've been talking about in the last few weeks, which is Europeans are being either sued or having groups like this put formal resolutions in front of shareholders to go faster in their transition and decarbonization, whatever that means, right? Whereas the companies themselves have been saying, from Shell to BP, who have been most notably public about it, we're tapping the brakes here. We're rethinking portfolio allocation, as Shell CEO has talked about. We've talked about that extensively as well. So you've got two very powerful shareholder advisory groups, one of which is now saying, we're not just going to kind of rubber stamp rote line up behind this activist XYZ resolution about, accelerating your path to decarbonization, Scope 3, Paris Accords, whatever. And so is it a single data point or a trend? I don't know.
Well, let's roll this right into our friend Arjun sent a tweet out Saturday with a link, I believe, to the Auto Line After Hours EV Bloodbath podcast. And I mean, are these the two Muppet characters sitting up there just bashing EVs? I haven't listened to it yet.
These are grizzled veterans and journalists that have been covering autos for a long time. They're all, I think, Detroit guys. I think one's actually in Virginia or Maryland. But there were two moderators, and then one Reuters and one Bloomberg journalist talking about really the assessment at this stage. Where are companies, the biggest players in the EV race? Where are they with respect to how their stocks are performing, profitability? What are the challenges to getting to these inflection point forecasts that we see, these hockey stick forecasts that we see in terms of EV adoption? And they're just being very frank about what dynamics are out there, what headwinds are out there. One of which is, look, they said Ford's the only one of the big three that's being transparent. I didn't know this about actually publishing their EV division standalone profitability numbers.
It's ridiculous.
They're projected to lose $3 billion this year after losing 2.1 last year and almost $1 billion the year before. GM is below its, I call it the re-IPO price. It's still amusing to me to think of GM IPOing in 2009, but GM is now trading below, or at least it was as of last Friday's close, below that 2009 IPO. And there were various bits and pieces. It's a fairly long podcast. It's an hour long. I had nothing better to do on a rainy Saturday morning, and usually take Arjun's recommendations. And I texted him. I asked him, "How the hell do you find this stuff?" And he said he's been listening to this for a long time. As you may know, he's talked a lot about being a Tesla owner, and but he's also been very pragmatic in some of the points that that are made in this podcast. And it really causes a revisit of fundamental issues. Like one of my old partners used to say, everybody can hold their breath underwater for a minute. Let's see who can do it for 10. And as it relates to automakers' profitability or lack thereof related to EVs, how much tolerance is there going to be for that? And as CEOs and their boards think about the gargantuan capital investments that they have to make to really scale up to the level of production, it's a pretty challenging and daunting set of headwinds.
I mean, I remember back in the day, 25 years ago, they would talk about if a car model design could last one more year, that was like $2 a share in earnings or something ridiculous, because they didn't have to retool everything. You're talking about, electric to ICEs. That's really retooling.
Sorry. I was just going to say, one of the things, I'm a firm believer in the all of the above, or the energy addition mantra, right? And we're going to need all different sources of things going forward, just based on scale. But you take the auto industry as an example. 10 years ago, the conversation was, how do you increase the mileage with your internal combustion engine? How do you take it from 30 miles a gallon to 50 to 70? And all of a sudden, somebody flips a switch, and efficiency for the ICE isn't as important as just going to EV. Now, the board's going to look around, the equity holders are going to look around, the debt holders are going to look around, like, well, why don't you just go back to improving the environment the way that you know how to do it, which is to make your cars more fuel efficient, because they're lower weight right now in terms of being able to use aluminum. And so why not improve the fuel efficiency? And sure, are you going to be 100% carbon free? Well, neither is an EV, but that's another story. But at the very least, you can take what you can have and you can make it that much better. And if the government wants to create a bunch of companies that go out and lose money in the orders of magnitude of billions of dollars a year, then let them do that. But to me, it's really hard to justify asking people for money knowing that they're going to lose. And these are not venture capital firms, right? These are, seriously,
No,
right?
that's right.
These are large established organizations. And it's like, hey, yeah, go ahead and you just take that $3 billion and waste it. And that's not the intent. And maybe that's too strong. But at some point, these companies, these management teams are going to be held accountable. And when they continue to lose billions of dollars a year, they're going to underperform the market.
Yeah.
And there was another industry recently that lost billions of dollars a year that underperformed the market. And what did investors do? It was energy, and they left.
Yeah.
So you've got to be thinking about things the longevity.
Or they said, don't spend that capital, give it back to us.
Give it back to us. Right.
Right.
All right, so we're going to get out on EVs with my rant, and I've done this way too often, but I'm going to do it again. Because you're right, the government came in with the IRA and said, it's electric vehicles. They didn't say, hey, however you want to reduce emissions, more fuel efficiency, we'll give benefit for that. They came in and said, it is electric vehicles. And the reason they did that, and I truly believe this, is they want to move us from cents per gallon buying gasoline to tracking us, and we're going to pay dollar per mile we drill, and they're going to have a sensor in our car, and it's just going to become de facto. They track us wherever we go, no court order necessary. That's how they're going to normalize paying dollar per mile, and the government wants that happening.
So Jason Bourne, I don't know that I entirely ascribed
Fair
that.
enough.
However, it certainly is going to be another reason why I might slow down the purchase of an EV. But if you think about this, if you think about the internal combustion engine and gasoline, what is the single biggest tax cost to you? I mean, who has the largest tax?
I mean, the federal government.
The federal government,
Federal
right?
50 cents
Unless you're in
or
California.
something. Yeah.
So the federal government is essentially cutting off its nose to spite its face. It's subsidizing a business that it's not making money on because you don't have the federal tax on your electricity bill.
But in
Right?
the IRA, there's a $25 million pilot program for tracking devices in EVs to measure mileage.
So- Okay.
And we'll bring this up next week since we're running out of time. The new EPA regulations that are related to carbon capture and storage for power generators, which
Mhm.
affects mostly coal and natural gas, obviously, are the kind of end around, right, unelected or non-legislated way to mandate more renewables on your grid.
Right. However, if you talk to people who live in River Oaks, who are familiar with the energy industry, maybe they actually are executives in the energy industry, they would tell you that even River Oaks, if you had an EV every 3 houses, the grid would collapse.
Totally.
Totally. Your point about the Inflation Reduction Act and all of that's all well and good to try to add supply to an equation. But if you add a bunch of supply somewhere and you can't get it to market, then it doesn't matter, right?
Yeah.
It's like we've talked about this before. What's the value of a TCF of gas in the ground with no pipelines? It's 0. What's the value of a 10 gigawatt solar farm? If you can't get it to the market, well, it's not 10 gigawatts, right?
Yeah.
And if the grid goes down, and there was another story we tweeted back and forth about Nigeria ordering 12,000 electric buses.
Yeah.
Well, their grid demand is 4 to 12 times the grid capacity.
Did
And
I share my Nigeria story with you?
about the monks?
Yeah.
Reshare it.
Did I share it with you?
I
All
don't
right.
think so.
So a couple of weeks ago, I went to a Trappist monastery in Kentucky, Thomas Merton,
Right.
and silent retreat, and it was awesome. But one of the things that I learned while I was there was I got to talking with a monk about global energy demand.
Nice.
Yeah. No, it was pretty cool. So the Abbey was saying prayers for the people that were coming in, trying to make the Abbey more fuel efficient. We're talking, and he shares with me that they have a monastery in Nigeria, which, according to all of the publications and press and check the box articles, has access to electricity. So they're not in energy poverty because they have access to electricity. They just bought them 2 diesel generators. The reason they bought them 2 diesel generators was because this monastery in Nigeria gets access to electricity between 12 a.m. and 4 a.m. every day.
Nice.
Now, they go to mass 7 times a day, but I'll tell you, no one is up at 2 o'clock in the morning.
Exactly.
So
So Nigeria spends
yeah,
$22 billion on mostly diesel generation. The grid has failed. The national grid has failed over 200 times in the last 10 years.
It's just crazy. And never in all of our talk about renewables do we talk about grid reliability. All right. So I think we're going to talk nickel mining next week. Real quick, Sean, I don't know if you've been privy to this, but my girlfriend's British.
Okay.
And she has
You love saying that, don't you?
She has chastised me and Mark for talking about Europe as kind of this uniblock, and we're 20 to 30 different countries.
They're all very unique.
They're Did you know something can only be unique or not? There are no shades. You can't be very unique. You're either one of a kind or not. I thought I would correct you on that.
I appreciate that.
Because I studied that for the SAT, and I haven't used that in 37 years.
And it's not close proximity either.
And it's not close proximity. Exactly. I like that. No, and so she's actually made a decent point. Yeah. So what we've been doing is we've been closing each show, and we originally called it a deep dive on each one of these countries. Our number one fan, Vlad, has said it's not a deep dive. It's more like a blurb. So we're going to do a blurb. This week, we're going to talk about Greece. I'm going to throw some quick facts at y'all and get a reaction. When you look in the 1970s, energy usage in Greece, 80% of it was oil, 15% of it was lignite. Greece has a lot of low-grade coal running around, and they stayed pretty much with that mix until you get into the 2000s, where some natural gas shows up from Russia. Mm-hmm. And then they dove into renewables. So when you're looking at 2010, you had oil accounting for, call it 40% of their energy, natural gas around 20, lignite 15, renewables 20, 25, somewhere in there. You look at 2020, they're up to 35% renewables at this point. So they've really gone all in. They're pre-COVID, right before, they were only importing about 50% of their energy, because they do have access to the renewables and then the coal, even though it's declining kind of over time. Some other interesting stats I'll throw out about Greece, but then I'll get to the punchline. So they have 35% more debt per capita than the rest of Europe. We all know that. We saw the Greek. They're the 16th largest economy in Europe, so they're kind of bottom half. They have an 11% unemployment rate, and obviously a big service economy. So why are we even talking about Greece? One, it's Greece. It's pretty. So Fred Willard, the stand-up comedian, do you remember Fred Willard? If you've seen a picture of him, he's been an actor and everything. He's really good friends with my friend T-Sean Shannon, and they would go travel around all over the place. And anytime they went anywhere in Europe, like if they were in Rome and they went to the Colosseum, he'd be like, "Oh, that's nothing. We got one in America. It's in LA. It's much nicer than this." The Eiffel Tower, all that. Supposedly got on a roll about the stealing. The frieze of the Parthenon, we got one in Great Britain. It's much nicer than this one here. But no, side note. The whole reason we bought up Greece, they're actually the largest ship owner country in the world. They've got 5,500 vessels out there. They've got more, I think you measure shipping in millions of tons, and they have about 20% of the world's tonnage out there. And what's really important about it, and why we just need to bring it up for people to think about, 1/3 of all oil moved around in the world in a Greek ship, 22% of LNG, Greek ship, 16% of chemicals and petroleum products, 14% of liquefied petroleum glass is moved around in the Greek. I think it's called the Greek Merchant Navy.
2 questions.
Yep.
One, in the renewables, what is the component that is biomass?
Ooh, good question. I do not know that.
Because Europe, not to generalize,
ooh, I like that,
at least in this past winter, has been burning quite a bit. I call it the big Traeger grill, right?
Yeah, pellets from Canada.
Which are exempt from counting those emissions largely. 2, what does the government in Greece, or what's the social benefit of having such a large market position in worldwide shipping? And I ask that because you look at the debt per capita, those seem to be, maybe it's order of magnitude different scale that we're talking about, but that seems to be a little inconsistent. Or is most of Greek shipping privately held? And what is the taxation around that? Do we know?
So that's the dynamic, and that's the fight. If you are a lender
Yeah.
to the Greek government, albeit the Germans or whoever is giving them the money, or at least demanding some fiscal austerity, you're going, you got a bunch of freaking rich people with ships everywhere, tax the hell out of them. And the rich people, as best I can tell from my reading, have such a stranglehold around the government. Oh, if you start taxing us, we're going to move to the Bahamas or someplace else.
Mhm.
And that's kind of the stalemate. And that seems to raise its head every 3 to 5 years. So,
Very cool.
yeah. Sean, thank you for joining us.
Always a pleasure. Thanks, Chuck.
It was
Mark,
great.
Yeah,
appreciate
Mark,
it.
great seeing you.
Mark, as always, good to see you. I kind of like this without Colin and Kirk. Did I say that with my outside voice?
Sign off with a Greek opa.
Oh, there we go.
There you go.
Opa. Opa. Digital Wildcatters, thank you for joining us. If you like the podcast, share it with a friend, subscribe to it, let everyone know. We'll see you next week. Peace out.